My name is Gareth Soloway, and I was a losing trader until I mastered technical analysis. Logic and charts beat hype and narratives every time. Now I teach investors the same techniques that made me a multi-millionaire. This is my trading game plan. Good morning, everybody. Welcome to my trading game plan. My name is Gareth Soloway, Chief Market Strategist here at VerifiedInvesting.com. So it happened. A few days ago, we talked about, and if you've been following my live updates, we've talked about how the CPI data would likely come in 1/10 better than expected. Now, again, that's exactly where it came in. Month over month, 0.2% versus forecast 0.3%. And the year over year came in, again, 2.4% versus 2.5. Now, how did I know this? Was it because I analyzed the data? Not even close. If you look at the jobs data we got on Wednesday, we saw participation rate slightly better than expected. Hourly earnings 1/10 better than expected. We saw unemployment rate 1/10 better than expected. All of these data points are coming in slightly better, but the market is not believing it. And the reason you know that is because the treasury yield, the interest rate, is collapsing. That's telling you the market doesn't believe the economy is better per the jobs report. And in fact, they're saying those numbers are nonsense. In addition, it's saying the economy is weaker than many people are letting on. And we're starting to see the charts, the S&P, the NASDAQ, the Dow, the charts that I have told you were at breakdown points and beginning to break down. They are breaking down, folks. Let's go into the charts and see what we have today, folks. Let's take a look at the S&P futures. S&P futures yesterday here, you could see the market collapsing. In the overnight, we kind of drifted sideways to lower. Then we got our CPI report right here. CPI report, you can see the market's caught a little bit of a bid because obviously it was lower inflation than the market was anticipating. Lower inflation potentially means the Federal Reserve will be able to be a little bit more lenient. Notice how all of these data points are going into being beneficial for the new Fed chair, whoever that may be. Right now, Kevin Warsh is the nominee. Assuming he gets in, he'll have more leniency to do those rate cuts that, again, the president wants, essentially. So just keep that in mind. Now, if we go to the bigger charts, let's look at the S&P itself and the daily chart. We've talked about this, right? So let's get rid of this trend line for the time being and just focus on the major points here. Here we have the upsloping white trend line that connects through all of these pivot points. This is where the breakdown officially occurred. Everything since then has just been chop that is essentially in breakdown mode, meaning that it's just essentially distribution. So understand what's going on here, folks, is that when the markets kind of get up to the all-time highs, it coaxes in more retail. And then you say, well, we didn't really break those all-time highs. We didn't surge above them because institutional money is selling into it. That's what's going on. In fact, if you look at the charts again, I want to make this crystal clear. This whole period from this hit right here, this was the end of the big, strong move up. Everything since, notice how we came down, we came up, we came down, we came up, we came down, etc. And we even did make a slightly higher all-time high. But the reason why the markets weren't getting the big move up is because you have sellers there. So essentially, if you have retail buying the narratives, right, they're buying into this, who's selling here that's not enabling it to go higher? Think about it logically. Look at all of these instances. Over and over again, the markets try and they fail. And the answer is very simple here. It's because you have smart money dumping into retail. In fact, this pattern formation, if you look at TA and based on what we're seeing, what type of pattern formation is this here? This is what we would call a rounded top, and it's a classic signal of distribution. In addition, I warned about this a few days ago, folks. We had a potential head and shoulders pattern, and I said, guys, even with this bounce, if we don't take out the high and we start coming in, what type of pattern does that form? That is a classic head and shoulders formation with a neckline right here. If we break this, you're going all the way down into this zone on the S&P. Now, granted, we have to see if we break the level here. Any daily close for me below basically 67.90 on the S&P would be that break point. But again, everything I've talked about here is coming to formation. It's coming to culmination. All right. Now, if we go over to the NASDAQ, very similar in many ways. Again, where was the actual top of the bull market here? Back in October, that actually in this chart was the official high on the NASDAQ composite. And then all of this has been distribution, and even this is distribution. And now it's starting to go lower. Now, does this mean that we're going to see an all-out crash in the markets? No. Markets generally don't crash off all-time highs because every X percent down, retail investors, which have been programmed for literally years to buy the dip, they will be buying the dip. And so what it does is it allows it to be a stair step lower. A few days down, a big bounce. A few days down, a big bounce. Once you get to the end of the move, that's when all-out panic starts because retail not only is dumping at that point, but they're certainly not buying the dip. That's for certain, okay? And by the way, if you look at bear markets, like look at 2009, if you look at 2008, that's where we kind of were stair-stepping down. But the real panic in the market was in February and March of 2009, which is when the low was. If you look at the chart, that's when the most vertical downside came in because people were just panicking left and right. We are not even close to that. I want to be crystal clear on this because, again, I think a lot of people think, oh, well, Gareth's saying, we'll be down 20% in a week. Nah, not going to happen. All right. Well, listen, I shouldn't say not, but probability, which is the world I live in, is very highly against that. We like a 5% chance of that versus 95, more a stair step to the downside. All right. Take a look at the 10-year yields. 10-year yields continue to come down. Remember, we had this area right in here, which was a resistance point. We broke out and we confirmed, and it's now failed. Okay. Flag patterns that break out or resistance that breaks out can fail. And the scary thing about that is when they fail, it's usually the big move comes. In other words, the old adage that I've said for the last decade, 15 plus years even, is the biggest moves come from failed moves. So in other words, think about this. You get a breakout in the yields. So everyone's piling in, oh, it's a breakout, right? It's going to go higher. Once that fails, they all run in panic, which creates a big reversion move back to the downside. And so, listen, I'm not saying yields are going back to 2%, but the fall here that we're seeing should not be shocking based on, again, everything that's going on, plus the failed move. All right, the dollar today continues to kind of just hold steady here. Again, remember, this was the bigger macro move here. We had a 618 Fibonacci retrace. Now we've come down. What type of pattern is forming here? All right, so again, think about this. What type of pattern in the micro? What's the micro time frame? This move down and this. All right, what's this pattern? It's a bear flag, right? So this tells us we're going to go down. In addition, what's the macro pattern? What's the bigger pattern? The bigger pattern is also bearish. You have this, and then essentially we have a flag pattern off of that. So the macro and the micro patterns on the dollar are telling us further downside. Okay. We're going to smooth over and move away from the macro side. We're going to look at more what is going on with individual names today. And of course, we'll cover silver, gold, major movers and stocks. I'll give you guys my swing trade and day trade levels. So here we have Pinterest. Pinterest is getting annihilated today, folks. Down over 22% currently. Now, what's amazing about this chart is it was already down since January 1st of 2026. It was already down 30%. It's now dropping another 22%. In fact, I have to zoom all the way out here and look at where it is. And let me bring up this guide here so we can see the pre-market numbers. So there it is, $14.42. Now, because, look at this. So as a technician, what I'm looking for is key pivotal levels, right? And really what we have to do is we have to say, okay, we're down here. What's your key level? Now, if you're a day trader, there's a little pivot. And let me zoom in on this so you guys can see what I'm looking at. And this is the nuances of day trading, right? Now, on a day trade level, I'll even zoom in even more. There's this little gap fill at $13.82. $13.82. So as a day trader, that is my first level that I might nibble on for a day trade. Now, remember, day trades things that we hold for a week, a month, a year? No. They are things you're in and out of intraday, meaning it could be minutes, could be even seconds, but usually it's minutes to 30 minute. A good day trade works out in probably 5-10 minutes, right? I mean, that's really what we're looking for when we're day trading. So that is specific to day traders. Now, for swing traders, what are we looking at? Well, you guys already saw I annotated this chart already. We have a major pivot low from the COVID low here in 2020 at $10. If this were to come down, let's say in the next couple weeks to $10, I would start to nibble on that. Absolutely, guys. So again, keep that on your radar. That to me looks very, very interesting as a swing trade level. DraftKings is also taking a beating here. It is bouncing though. So again, I hate stocks going into the open that bounce, because ultimately I want to buy them and I need them at their lows or making lower lows. But if we flip this over here and we zoom out, we can see that DraftKings again is now down in the $22 range, starting to look for day tradable levels that haven't been hit today yet. And the first one that jumps out at me is right through here, $19.50. Why? Well, just look at this, right? So we have this pivot here, and then you can see it got briefly above, then it hit it again, it rejected it, hit it again, rejected, finally broke out and started to make its big move. Now you might say, well, why not this level here at $21? Because really, in theory, this would be a good level right here, right? It's actually a gap fill as well. There's a gap fill here, pivot high here. The reason is because if you looked at the pre-market, right? If we go to the pre-market, look, price was below that level pre-market. Now, one of my rules that I abide by, and by the way, discipline is so important in day trading, but it's important in swing trading and investing as well, right? I mean, that's what keeps you from buying silver at $115, $120 is discipline. You have to recognize that that's lunacy and that you're putting yourself in abnormal amounts of risk. But especially in day trading, because it's such a short time frame, discipline is important. So for me, it was trading down below 21, where if we go back to this line here, this line was again at 21.36. So we were already below that. So I don't want to trade that anymore. At least for me, that's the discipline that I keep. But we haven't hit this level yet at 19.50. So I would probably day trade that. Now on a swing trade basis, this is tough, guys. I mean, where do we go on a swing trade basis? Which one of these? And again, it's hard to know. Maybe you start to nibble a little bit at 19.50, but I see another good level here at around 17.20, which could also be a good technical level. Rivian surging to the upside today. Great move on Rivian, folks. Again, it's kind of the long lost Tesla cousin in that, it's a EV maker, but it kind of never got the hype that Tesla has gotten, basically because it doesn't have an Elon Musk leading it, right? And Elon obviously carries a lot of power with him. But when we look at this chart, we can see that it was beaten down on the daily chart. It bounced, then it came back in. And today, let me throw up where it's currently trading in the pre-market. You can see this is a great bounce. Now, as a day trade, right here, see there's a gap right in here. This is important to see, guys. You got to be able to see this stuff. There's a gap from this close here to where we open down here. That creates a gap. Now, what I know from technical analysis is that if we fill the gap, we should see some resistance. Because price on Rivian is still below that level, that would bring up a potential day trade at 18.85 for a day trade short. Now, only a day trade. What about a swing trade? Swing trade's tougher. When I zoom out on this chart, look at this. Look at this. Does that make me feel comfortable shorting at any point in the near term here when I see that price at one point was way up here? I mean, literally, that is massively up. Now, listen, this was the hype of the EV period, right? I mean, it's doubtful in the near term we're going back here. But even so, I mean, what's to say we don't go back to $28, which is just right here? And ultimately, that puts me at too much risk to even think about a swing trade short. So I sit on the sidelines. I may day trade it on the short side, but I certainly am not swing trading it. Applied Materials. The biggest by market cap by far today, reporting earnings yesterday after the bell. The stock surging to the upside on AI demand. Of course, it's always AI demand. Now, the kicker here is, number one, it's up about 10%. So it's up decently. for about a $250 billion company. But where is the trade? Because this one does get my attention as a swing trade short, because I say to myself, okay, well, we're at a point now where this is in price discovery mode. It's way up here. I mean, basically, you're trading around 360 up here. I can throw that in again for us so we can view that where it's trading. There it is. So the question is, how do we find these levels? And these are tough, right? I mean, again, for me, I start drawing trend lines that are ascending and connecting highs. And so for me, again, there's the trend line here. It actually goes all the way back down into this little area right there. That could be one opportunity. That's right now around 390. It's about 10% away or so. But again, right now, that's all I have for you in terms of a potential swing level. I don't have anything major. I'll do more research on it. But again, very clear trend line there could denote an opportunity. You could also do parallels, but then the parallels may not be good enough, right? In other words, we might already be above it. So you could do it here, or you could do it here. Here, very clearly, we're way above the parallel. But one thing I want to show you guys as education is look at this. So here's your low, here's your high, here's your low. Look at this. We got above it, and then where was the pullback just recently on AMAT? Right to that high level. Isn't that cool? I love that stuff, guys. It's just so cool to watch how the trend lines, even though we've broken this trend line, it's not like the trend line's not useful anymore. On a pullback, it actually was perfect support for the next move up, as I just moved that by accident there. But the point being is we'll keep an eye on this one. Roku having a great move. Roku's another one here. So number one, it's been beaten down, right? And so if we throw in our pre-market data, $95.50, it's only back to here. As a day trade, this low pivot at $100.50 would be my first level for a day trade. As a swing trade, zoom out on the charts. And yeah, I'm not looking to swing trade this on the short side anytime soon, right? So these beaten down ones, and you might say, well, why? I mean, why not swing trade this? Well, number one, there's always a chance. If I can find multiple factors, then I might do it anyways. But you need a lot of factors because there's a lot of risk of a short squeeze and these type of parabolic moves. Now, it doesn't mean it's going to happen. But again, as a trader or investor, we're always analyzing risk versus reward. Okay, so my risk might be a 10% pullback, or I should say my reward could be a 10% pullback, but is my risk a 30% short squeeze? I mean, that's not really the risk reward we want to get involved with here, right? All right, guys, one last chart that I'm keeping an eye on, Netflix for a swing trade. It's not moving much today, but keep this on your radar, $69 to $68. Look at the fall on this thing. It's only about $6 away or so, $6 to $7 away. Big swing trade level on Netflix. Bitcoin micro bullish pattern is still intact. Again, to make it even clearer, we can put in a little bit of a parallel here, and you can see, again, green up, inside bar. Now, the bigger macro is still bearish. So again, any sort of move up, I still think it could get back to 80,000 or so, maybe even above 80,000. But aside from that, after that, I would exit myself, as again, I don't trust it because of the bigger macro pattern. Gold, good bounce today on the back of the CPI data here. Big down day yesterday, but notice it's still stuck between resistance and support. So really, again, you'll hear me kind of gloss over these charts because as long as they're staying between this level and this level, there's not much to do. It's just choppiness, right? Same thing for silver. If we look at silver here, silver, great downside yesterday. I mean, that was a big fall, but look, it's still holding 70, 71, and it's still below 90, 91. So really, it's just chop. This is all just chop within about a $20 range, which is kind of wild considering that silver. Crude oil today, a small down day. Yesterday, again, it did fall as treasury yields started to price in a weaker economy. Oil did come in because of the demand side there. Nothing major there, but again, nice little dip on oil. Oil's down slightly today. And then lastly, natural gas here. If we bring it up, nat gas has done almost nothing the last few days after this big move up, big move down, bear flag push. Notice the moves are kind of condensing. Still have support around 273 on this chart. So listen, folks, this is big. Now, it's big not because we're having a major move in the markets today. In fact, today's the day before a 3-day holiday, right? We have President's Day here in the U.S. on Monday, so stock markets are closed. But the charts on the S&P and the NASDAQ and the Dow, in fact, I got to show you the Dow still, guys, because this was one of the big calls that I made, and so many people were not believers. but you have this trend line on the Dow. And we even put in a topping tail right here that I talked about a couple days ago. Look at that drop on the Dow yesterday, 670 points. Boom, right there. All right. So again, charts are charts. Now listen, charts are not 100%. There's no such thing as 100%, but it's probability. And when you start trading like you are the casino, not the gambler, that's where things turn. At least that's where things turn for me by focusing in on charts. I certainly have my losing trades here and there, but it's a high win rate that just keeps me grinding out generally month after month profits. You guys go have a great one. I'll be back for the weekly wrap up today after the close. I will see you then, but let's go make some money. Have a good one, guys. Take care.